Hello and welcome back to the channel where we break down the most intriguing hard-to-borrow stocks and potential short squeeze setups. Today, we're shining our spotlight on a small but volatile player in the industrial sector, INLF Limited, trading under the ticker INLF. This stock has recently popped up on our screeners with some incredibly high cost-to-borrow fees and a fascinating recent corporate action. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Joe Company logo /IN for card INLF Limited, or INLF, operates in the industrial sector, specifically within specialty industrial machinery. The company, through its subsidiaries, is focused on the research, development, manufacture, and sale of injection molding machine dedicated manipulator arms under the INLF brand, primarily in the People's Republic of China. With a current market capitalization of just $5.04 million, INLF is firmly in microcap territory, and these smallest stocks can often exhibit exaggerated price movement. Looking at recent price action, INLF has seen quite the roller coaster. Today alone it's up an impressive plus 21.31%, and over the last 5 days, it's surged plus 62.38%. However, looking back 30 days reveals a stark contrast, with the stock down a dramatic minus 94.7%. Joe price chart. What's cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow, and why should you care? When someone wants to short sell a stock, they first have to borrow shares from another investor, usually through their broker. They then sell these borrowed shares, hoping to buy them back later at a lower price and return them to the lender, profiting from the difference. Just like borrowing money, borrowing shares comes with a cost, the cost to borrow, or CTB fee. This fee is an annualized interest rate. When a stock is hard to borrow, it means there's high demand to short it, or a very limited supply of shares available to lend out. This scarcity drives the CTB fee sky high because lenders can demand more for their shares. For short sellers, these high fees directly eat into their potential profits and can quickly turn a profitable short position into a money pit. Why the stock is hard to borrow right now. Now let's talk about INLF. Our screener shows an astonishing annualized cost to borrow fee of 923.7%. Highlight CTB number to put that into perspective. Most stocks have CTB fees under 1% or even 0. A fee of 923.7% means that short sellers are paying nearly 10 times the stock's value per year just to hold their short position. This indicates extreme demand to short INLF, or critically limited shares available to borrow. The estimated float for INLF is quite small, at around 1.0 million shares. A small float means there are fewer shares trading freely in the market, making it easier for demand to outstrip supply, both for buying and for borrowing. While we don't have current borrow supply numbers, a CTB fee this high suggests the well of available shares is drying up. Our internal composite squeeze score for INLF is currently 45.2 out of 100, which is respectable and flags it as one to watch. Squeeze mechanics explained. So, how does a short squeeze happen? Imagine short sellers betting that INLF's price will go down, but instead, it starts to rise, perhaps due to positive news or increased buying pressure like we've seen today. As the price climbs, short sellers begin to lose money on their positions. Add to that the incredibly high 923.7% cost to borrow fee eating away at the capital daily. At some point, many short sellers will decide to cut their losses or simply can't afford the borrow fees anymore. To close a short position, they must buy back the shares they borrowed. This buying pressure, often forced, can trigger a cascade, as some short sellers buy to cover, the price rises further, which then forces more short sellers to cover, creating a rapid upward spiral in price. That's the essence of a short squeeze. Dilution risk check. One critical factor that can negate a short squeeze is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can provide liquidity for short sellers to cover their positions without driving up the price, or simply depress the share price due to increased supply. In the case of INLF, we found no recent dilutive SEC filings such as SMINUS1, SMINUS3, or 424B in the last 90 days. This means the company hasn't recently added new shares to the market, which is a positive sign for any potential squeeze thesis, as new share issuance wouldn't be readily available to relieve short pressure. Recent reverse split watch. Now, this is a very important detail for INLF. Just 24 days ago, on July 6, 2026, INLF executed a significant 1:4-200 reverse stock split. Joe calendar/data reverse split reduces the number of outstanding shares and proportionally increases the share price. So, for every 200 shares held before, an investor now has 1 share. This dramatically reduces the public float, which for INLF is now estimated at 1.0 million shares. Historically, with many microcap stocks, a reverse split can be a catalyst for renewed volatility, and sometimes even a price pop within about a month after the split. This is a pattern observed in some specific instances, not a guarantee, but it's certainly a factor that could be contributing to INLF's recent price swings and high CTB fee. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For INLF, several factors are at play. You have an extremely high cost to borrow at 923.7%, a tiny float of 1.0 million shares, and significant recent volatility, including today's plus 21.31% jump and a plus 62.38% rise over 5 days. Keep in mind, today's volume of 2,147,700 shares is only about 0.5x its 30-day average volume of 4,287,842 shares, indicating this recent price movement happened on lower than average turnover. The recency of the reverse split also adds another layer of potential short-term volatility. It's important to remember that a high cost to borrow does not guarantee a squeeze. It can also signal that short sellers have very strong conviction that the stock will eventually fall, and they are willing to pay a premium to maintain that bet. INLF Limited INLF presents a fascinating case study in the world of hard-to-borrow stocks, combining a micro-cap profile, an astronomical cost to borrow, recent price momentum, and the aftermath of a reverse stock split. This complex combination makes INLF a prime example for understanding the mechanics of short interest and potential squeeze dynamics. Remember to always conduct your own thorough due diligence. If you found this breakdown helpful, please smash that like button, subscribe to the channel for more unique stock insights, and let us know in the comments if you've been watching INLF or have any questions. Thanks for tuning in, and we'll see you in the next one.